This is Benzinga Live with Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, Benzinga Live? Welcome back to another episode. Let's go ahead and start the show as we normally do, taking a look at the overall market, seeing what's going on today as well. So I'll give you a brief rundown of the show today. So we're going to bring my man Nick Brown on here in about 10 minutes, and then we'll be talking to an interesting biotech company, BioRestorative, at 12:15. So excited for that as well. Go ahead and smash the like already before we even begin the show. Let's go ahead and get that Benzinga Pro pulled up. Let me know in the chat which stocks you guys are watching today. Tesla has been on an absolute run all year. I did want to talk about some Tesla today, as well as a brand new energy stock pick that I have. I may have talked about this on the show a few months ago. I gave it to my man Hot Stocks Luke Jacoby, who put some into his portfolio. So I'll have to follow up with Luke and see how much he's up on this brand new energy stock pick that I had, performing pretty well today. So get excited for that. All right, guys. Got the Benzinga Pro pulled up, as you guys can see. We're pretty green today. Let's go ahead and check the S&P 500. Up about 0.5%. Going over to the Qs. Up 0.8%. Tech was your laggard yesterday. Tech has been kind of trading down the past few days. So I was never getting like that worried that, okay, we're going back down after a few red days. But you can see on the RSI down here, we had just gotten overbought. I think last week I was talking with Steve Kalasian and some of our other guests that, look, we were due for a pullback. Yes, that could have or may not have been the pullback that we got, but I mean, it's unreasonable when you look at how much the S&P 500 or how much the Qs are up this year, like year to date, to just expect that to continue day in and day out. You're going to have these little pullbacks. That's healthy. That doesn't mean there's anything necessarily wrong going on with the market. Doesn't mean you need to go out and start selling all of your stocks. Does not, I'm actually curious about this because I know 2 weeks ago when we checked the AAII sentiment survey, so looking at how retail investors are feeling about the market, whether they're bullish, bearish, or neutral. 2 weeks ago, it was the highest point in the past 52 weeks because the market was at the highest point in the past 52 weeks, so people were feeling pretty bullish. Then the market went down, 4 out of 5 days, so let's see if that number dipped down a little bit. It did. So you can see the week prior, so the week ending in June 14th, there were 45% of individual investors were bullish. Then that number dipped slightly to about 43%. But you can see the percentage of people that became bearish week over week grew by more than 5%. So over that week, you had a few people become less bullish, but more so you just had more people leave the neutral camp and go into the bearish camp. Because again, you had red days 4 out of the past 5 days. I saw it as a buying opportunity. I took that opportunity to add some money and buy some stocks, which is Unity is ripping. Let's check out Unity. Someone's talking about RCL. I haven't looked at the cruise lines. Oh my god. I mean, yeah, these things are ripping. Still not back to the pre-COVID levels. But the thing with the cruise line is I'm pretty sure most of them pay good dividends too. Sorry guys, give me 1 sec. All right, Unity. I mean, there are a lot of stocks that are just absolutely ripping. Look how Upstart's been one that I've been watching just from like a chart standpoint. Like this is starting to look decently attractive. I just don't know. I just don't know if this market we're heading into. So the way I see it right now is that we have entered a new bull market, but to me, it's truly been driven by the strength of the economy, and I think that the unexpected strength of the economy, right? You know, it was a foregone conclusion that we were going to be heading toward a recession, and we've avoided it despite the Federal Reserve raising interest rates higher for longer than initially expected. So, with all that considered, the economy is doing really well. Is that going to provide a market environment that stocks like Upwork, stocks like Roku, these like high, growth stocks, are those going to rip, as high as they don't need to get back up to their all-time highs where they were at, November 2021 or February 2021, November 2020, like end of the COVID markets. I'm not saying they necessarily need to get back up there, but these things are gonna have to get pretty overvalued in the like fundamental orthodox sense when you're looking at stocks. Like the PEs are going to have to get really high for them to even start getting back, like for Upstart to get back to 100, say. It's at $32 right now. Looking at the chart looks good. I like the way this chart looks because it's found a bottom, has been trading sideways for a while, and has started to come up, starting to show legs. You have a slight dip here, and it looks like it's starting to catch a bottom again. So I like Upstart stock a lot right here from a technical perspective, from a chart perspective. My question, though, is just like, again, is the market environment truly going to be one with 5% interest rates that's going to allow these high growth tech stocks to really start running? I think if you were going to play this to the long side, kind of this $80, $90 level looks like a good, gap fill to the upside. I mean, before you get up there to this 56 level, which would still be, looking at the chart, it doesn't look like that huge of the move because here's where we are right now at about $35. To get back up to here, this double top would be right at $55. And it doesn't look like that big of a move, but from where we're at right now would still essentially be an 100% gainer. So I don't mind taking a stab at Upstart right here. Again, that's ticker UPST. Sydney is saying shorts flocking into BTTX. Check it out. Black Diamond Therapeutics. Wow, up 100% on the day. See, okay, like this chart honestly kind of looks similar to Upstart's, but to me it's not as attractive because Upstart has this nice rounding pattern on the bottom where you can really see it starts to shallow out, and then it kind of has a slow back up, boom, a big jump that shows it's got some legs. This one looks like it's just kind of been, dead, and then all of a sudden today it's up 100%. So this one would scare me a little bit. Black Diamond Therapeutics shares are trading higher after the company announced initial dose escalation data demonstrated anti-tumor activity of BTTX 1535 in non-small cell lung cancer patients across EGFR mutation families. So it sounds like this biotech company got some good data. Stocks up 100%. Again, to me, like this is scary. I wouldn't really probably be touching it right here, but watch out. I mean, if you're looking to make a speculative bet and like hope that a company goes up and keeps running another 5%, 50%, then yeah, I mean, like take a stab, but just know that there's a lot of risk and speculation involved here. All right, catching back up on the chat. Let's go to Benzinga.com real quick and take a look at some of the top headlines of the day. All right, unmasking Q2 2023 stars and strugglers, industry ETFs, and stock standout. All All right, so this is from my man Piero. As the second quarter comes to a close, it's time to look at the performance of industry ETFs and the stocks that helped their respective sector returns. So you have, um, let's see, the best performing industry ETFs in Q2. Home construction. ITB invests in U.S. companies involved in home construction and improvement, allowing investors to participate in the housing sector. Wow, I would not have guessed that. VanEck semiconductor ETF. This is the one that I would have anticipated. You see Nvidia up about 1% today, 410, coming back up after trading down for a couple days. Adobe trading higher, Microsoft trading higher, Oracle trading higher. So we have VanEck semiconductors, expanded tech software sector. Jets. That's one of my favorite ETFs. Not really necessarily like favorite for investing, but just the I just like the name. Damn, TAN. Invesco Solar ETF. The clean energy ETF was your worst performing one. A bunch of clean energy ETFs here. Regional banking, KRE, also not so great. How are our regional banks doing today? Let's go ahead and take a look at some of these names. I mean, it's been a wild past few months. It's so funny, like thinking back to Silicon Valley Bank, the collapse and everything, because it doesn't feel that, or it doesn't, it feels kind of long ago, but if you think about it, it was probably what, like 2 months ago? Let's see. Or was that in March? It was either in March or May, I want to say. March. Okay. So that was about 3.5 months ago. $100% was SoFi a few weeks ago. Wait, what were we coming over to? What were we coming over to check on? Oh, the regional banks. All right, CFR, Colin Frost. I think these are still buying opportunities. I mean, we saw there was some weakness in regional banks right now, but a lot of these right now are trading below book value. Look at something like a Western Alliance. You look at something like a Colin Frost Bankers. You look at a Stifel. A lot of these companies, these big regional banks, or sorry, not big, but regional banks are trading below book value. So they pay good dividends, and you get the benefit of, okay, if the stock doubles and it's paying a good dividend, bam, now you got that double whammy. That's what I love, is looking, if I'm already looking at a dividend stock, I want to find one that's like, trading very, very inexpensively, which I still believe a lot of these regional banks are. I think a lot of the problems. Okay, so think about it this way. You look at Western Alliance's stock right now, or stock chart right here, March 5th, whatever. Here's where the March 14th, here's where the regional banks, collapsed. Silicon Valley Bank, everything went downhill. The fears here were that regional banks were basically all going to be screwed across the board, that there was going to be all this, all of a sudden withdrawal pressure, and the banks weren't going to have enough capital on hand to meet that withdrawal pressure, and that they all had holes in their balance sheet from holding treasuries that have now gone down because interest rates have gone up. But that hasn't really happened to the most part, right? You did have an increase in withdrawal pressure. You did have some companies start taking money away from regional banks and maybe putting them into safer things like treasuries. I'm not sure. But for the most part, regional banks have actually been holding up decently well over the past few months. So to see Western Alliance still trading down here, to me, sounds and looks like a big buying opportunity, one that I'm interested in. So I know a couple weeks ago, who was it? Western Alliance, someone that reported actually grew deposits like in the previous quarter, which was a surprise, and regional banks started trading higher. I know there was a lot of talks about regional banks during Jerome Powell's testimony to Congress last week. First Republic started trading on OTC lately. Who would want it and for what reason? I would not touch FRC. Although First Republic Bank, it looks like shares are up 20% today. Maybe this one? I don't know. There seems to be other different tickers. I wouldn't touch First Republic, but like a Western Alliance, maybe it's something a little bit more that I would touch. I think a couple other banks. But no, Jay, completely honest, if there has been some like very negative news about the regional banks in the past couple weeks that I haven't seen, let me know. Would love to discuss that. All right. Let's go back to our Benzinga.com and go through some other top headlines. Alphabet's AI ambitions are pressuring earnings, analyst says, and downgrade. See, this is always the big dilemma, right? Is do you want to spend more money on, research and development for things that could be huge down the road? Oh, wow. FRC is up 300% in the past few days. The stock has gained about 40% from its November lows. It's time to move it to the sidelines. According to this analyst, Bernstein, the Alphabet, the analyst's name is Mark Shmulik, downgraded Alphabet from outperform to market perform while maintaining an $125 price target. Alphabet takeaways. While the focus is on artificial intelligence, there is stiffening competition from retail media, shift in market share to meta platforms, and some Gen AI pressure capping near-term search growth. I mean, so here's the thing. There's with Google, I'm a fan of Google's stock, Google's company. I'll probably always be a shareholder of Google throughout the rest of my life. Probably. No promises. I hold my right to change my mind. With that said, you have a few things going on with Google right now. You have obviously ChatGPT, Microsoft trying to make a huge push in capturing some search engine traffic from Google, saying, hey, look, we have all these things that you can search on ChatGPT and get these curated answers as opposed to Googling and going through all these links on your own. Okay. I'm not, to me, that's like a level worry, 2 out of 10. Like, do I really think, when I'm on my phone and I need to look something up, I still Google something. I think most of my friends are in the same boat. Until I see people start using ChatGPT for like mundane I understand if there are certain things, if you're like, hey, I need a suggestion for what type of smoothie to make in the morning after I get my tonsils taken out. ChatGPT might be better at that. They might, give you some recipes. They might, whatever. I think other stuff Google is still far and away better for. You also have, it says, the analyst was citing the fact that you have people, Meta, like YouTube to me is always going to be around. But I think with the short form, I think TikTok and Instagram are both right now doing a little bit better on the short form video. YouTube does have its own version of that, the YouTube Reels, but I don't think it's been doing as well. So you have that aspect from Google as well. You have the AI, but again, I'll probably always be a holder of Google throughout the rest of my life. But I also think the company will be prevalent in AI. It basically will have to be. It would make essentially no sense for it not to be. When you saw the stock get absolutely hammered a few months ago when it released its Bard thing, and then people were saying it made some mistakes and wasn't good as ChatGPT, and the stock went down 10% in a week and then rebounded really nicely. And I think, Google, Amazon are all going to be players in AI. All right, y'all. Going back to Benzinga.com, we do have some more top headlines to get through. Tesla moves toward gap fill as market volatility increases. The bull bear case for Elon Musk-led stock. Tesla stock fell over 6% on Monday, entering a lower gap that Benzinga pointed out on June 12th. The move lower comes in line with a downturn in the general market, which has seen the S&P 500 index retrace nearly 3% lower since topping out at 4,300 on June 16th. While the CBOE volatility index tracked by the ProShares Ultra VIX short-term futures ETF and other tickers fell with the stock market initially, that index closed over 6% higher on Monday, signaling that the stock market volatility is increasing. All right. Tesla. I don't know. I mean, you can see right here, this RSI, it just got a little bit crazy. RSI got like to 90, just some insanely overbought. Pulling back here to 240. It's funny. I wouldn't really feel that comfortable going long or short this stock right now. I'd probably err to the short side. Just because while you do have some great bullish activity right here, if you zoom out, it still kind of looks like this thing is making, lower lows. Like we didn't get back up to this. We'd probably have to get back up above 300 for me to start really being interested in going long Tesla. Look at Kava's chart, guys. Kava's been killing it. Jay saying Nike has a nice move going into earnings. Check this out on the daily chart. Yeah, I mean, here's the thing with a company like Nike. You see a dip like this from 180 down to 80. Of course, there's going to be like the only reason you're going to see that is because there's probably bad things going on, right? Whether it's macro, whether it's company specific. I think in this case, it's a little bit of both where people were worried about a recession. You had some companies like Foot Locker and Nike report some, a little bit less growth than wanted, or a little bit maybe of a weaker consumer than initially anticipated. But every time I see a stock like Nike that goes from 180 down to 80, down, 50, 60%, and it's a brand that has that much recognition, I look at it as a buying opportunity. I'm sorry, Nike's not going anywhere. Is Nike going to continue to face increased competition from other shoe brands popping up? Sure. Yeah. Could the consumer get weaker if inflation gets higher, or the, Fed keeps raising rates and the economy slow down? Of course. The consumer could get weaker. But does that mean I think, Nike's not going to be, around anymore? No, of course not. And it's not just about being around, like surviving. It's about, when I say being around, I mean like as the premier shoe that people buy, right? People want Nikes. People want to buy Nikes or, Adidas or Reeboks. They don't want off-brand stuff. They don't want the, and one shoes from Walmart that you can buy for $20, $30. They want the Nike logo. So when I stop seeing that, when I stop seeing people, or I see people start saying, "Oh, Nikes aren't cool anymore," or whatever, then okay, that's when I'd be worried about the stock. That day ain't coming anytime soon. I can guarantee you that. All right, I see my man Nick Brown just hopped in backstage. Let's go ahead and bring Nick on. We'll give him our special intro and see what stories Nick's been watching. Hey Nick, how are you?
Hi, AB. Sorry for the late. It's been a day.
All good, man.
I was gonna watch. Been watching a lot. Been watching Nike as they report earnings Thursday after the close. It's going to be very interesting to hear how the China front is. More areas are cutting the China GDP for 2023. I think S&P Global just cut yesterday. I was off yesterday, but I was still trying to tune into the different news outlets and to see what was going on. But China, we have Robinhood layoffs, Ford layoffs. We have a lot of stuff going on today.
Yeah, let me go ahead up and pull up Ford. Ford actually traded higher, about 0.7%. You mentioned some layoffs there, as well as at Robinhood. Robinhood stock, is hasn't been great at all, Nick. You can see from the chart here, but it's been trading higher. I mean, look, we got down to about $8 flat, up almost to 10 here. Like you mentioned, a little bit more layoffs going around. Anything else you've been watching?
It's just very interesting to hear what Robinhood is doing. And they're in the comments. So the Wall Street Journal was actually the one that scooped this news. And in that Wall Street Journal memo, they saw that the chief financial officer, Jason Warnick, he made this comment, said that the layoffs were made to, quote, adjust to volumes and to better align team structures. I'm not exactly sure what they're trying to align. I thought Robinhood has been doing pretty well over the years, that they've been getting this engagement, but the stock has just not been responding overall. You can see that big upturn from when it went public, and then ever since it has just declined, and there has been so many issues. When he says that they're adjusting to volumes and to a better aligned team structure, does that mean a lot of people are closing their Robinhood accounts? Is Robinhood not the number one source now to trade? I would want more clarity around that comment.
Yeah, I think Robinhood, unfortunately, timing wise, you look at when it IPO'd August 2021. This was kind of the very, very tail end of the crazy COVID markets when interest rates were still very low and everything was running. And specifically, the end of 2021 in November, a couple months after this, was really the peak of the growth run. Like the S&P 500 didn't end up topping out until a few months later in January. But basically anything really growthy topped out in late 2021, not January 2022 like the S&P 500 did, right? You look at a chart of Bitcoin. Let's see. Yeah, this was November 2021 when Bitcoin was at 68,000. And then by January, this thing was only at below 50,000, the Bitcoin was. Whereas you look at the SPY, S&P 500, and you go back here. Where are we at? I'm going to zoom out so I can see the top. The S&P 500 topped out in January 2022. So the overall market kept moving higher, but growth did not. And that's when Robinhood IPO'd. Robinhood IPO'd right at this kind of peak moment of growth.
Yeah, I was going to say to the IPO market, this week, we're actually going to have 4 IPOs on deck this week going to the New York Stock Exchange, supposedly. Fidelis Insurance, it's a property reinsurance company, priced at around $298 million. Kodiak Gas Services, natural gas, priced at $328 million. Savers Value Village, it's a thrift operation, that's priced at around $300 million. And Vesta Real Estate, that's priced at about $401 million. So we've had this IPO thaw for a few years now, and it looks like that IPOs, this is the right time to launch, to come back, because take a look at Kava. Kava priced at like $20, $21, $22, and it opened well above that, 42, 44. And maybe it's a sign that the IPO market needed a little break, and now it's going to be back in full force.
Yeah, 100%. I mean, the IPOs right now, we saw Kava the other week, which I think at the time of that day when Kava IPO'd, it seemed like, at least to me, I don't have any data to back this up off the top of my head, but it seemed like that was like the most talked about or anticipated IPO we had in a while. And if you go back to and remember at the, during the COVID markets, it seemed like we had a big IPO every single day.
Yes. But as we pivot to earnings season, and earnings will pick back up about next month, I believe we'll be getting bank earnings the 18th of July. Joe Terranova of Virtus Investment Partners, he mentioned yesterday on Halftime Report, I caught this, and he says, no matter what, inflation, war in Ukraine, Russia, no matter what event other happens, earnings are the big thing that people are going to be watching. Earnings are going to have the tone that's going to be set. And I actually do have to agree with him. I think earnings, as we start Q2 earnings season, the transcript's actually noting it starts next week. As we get these different companies from all the different sectors reporting, it's going to be very interesting to hear what the Chevrons, what the Walmarts, what the Lululemons, all the different earnings companies, how are they managing inflation? Is inflation coming down? How are they going to be able to say, hey, we're not going to be able to lower guidance. We're actually thinking we're going to raise guidance. Guidance is going to be the key. Just because you miss top and bottom line for the quarter, guidance is going to be key. I think guidance is really going to be driving the fuel. Driving, is the stock going to be up? Is the stock going to be down? How's that conference call looking? Is the CEO, CFO, are they making positive comments, or are they saying inflation is still out of control? It's still hurting us. We're not seeing a lot of foot traffic. Data Trek in their newest note says Wall Street is looking for a 0/slightly negative revenue growth on a year-over-year basis, a very unusual outcome outside of a recession and an outright negative earnings comps to last year. Is recession coming? There's so many questions, Aaron, that when earnings season starts, that it's going to be unbelievable the amount of questions each sector, each company you could ask the CEO, the CFO on the conference call.
Yeah, and I like, Nick, that you mentioned the Chevrons, the Walmarts of the world. What are their earnings going to say? Because if you look at, I mean, even go back to 6 months ago or whenever the Fed really started raising rates in a meaningful way, and you had these tech companies start doing layoffs and whatnot, a lot of people, you think about it, our Amazons, our Apples, our Microsoft, they get so much attention and media coverage. I mean, they're huge companies in our culture too, just like our day-to-day life. Everyone's on their iPhone and Apple MacBooks and AirPods and everything. So when you hear about Apple doing layoffs or you hear about Amazon doing layoffs, it sounds super serious, like, oh my God, the economy is not doing well, there's layoffs everywhere. But really, these tech companies doing layoffs are not indicative of the overall economy. So looking at your Walmarts, your Chevrons, if those companies are doing well in terms of earnings, it's usually because the underlying economy is doing pretty well, right? What does Chevron do? They sell gas and oil. People are buying gas and oil when there's economic activity going on, when people are driving somewhere, when people are driving to work, when people are driving to the store to spend money. What does Walmart do? They sell things. So Walmart's earnings are going to be good when people buy more things. That's stimulating the economy. So you'll be able to get a better reading of the actual economy by seeing, okay, what's going on with these companies' earnings, the Walmarts, Home Depots, Chevrons, etc. Now, in terms of the stock market, you can see how the stock market's doing by seeing how the stock market responds to earnings from pretty much a lot of different types of companies, but I think especially the big tech ones. If you go back to when the market did top out in 2022 or 2021 and we started that bear market, all the major tech companies reported record-breaking quarters, like had made the most money in Q4 of 2021 than they ever had. Yet the stock started trading lower after the earnings. So that gives you an insight into how the actual market is responding to these things. But if you want to know how the economy is doing, you just look at the earnings of the big value brands, your Home Depots, your Walmarts, your Chevrons, etc.
I think China is going to be a major focus for Nike, Apple, all the semiconductors, any business that does business over in China what is the coming back looking like? What is the reopening looking like? Are people spending in China? I think there were some numbers out of the one festival in China that, yes, they did great, but they were still lower than 2018, 2019 before COVID. But it's going to be very interesting to hear what Apple is doing. Is Apple still hardly core manufacturing over in China? Are we moving away to India? As Prime Minister Modi was just here, are we moving to are we moving to Asia? How is China going to impact these companies? How is the dollar going to impact for the companies that does the foreign exchange and all the foreigner dollars? Is that going to have an impact on their earnings when they report EPS and the revenue and even the guidance? There's a lot that we have to take into, a lot of consideration when earnings starts. We don't only have to look at the top and bottom line. We have to look at the guidance. Do we get the guidance? Is the guidance above the street estimate, below the street estimate? Was the bar set high? Was the bar set low? What kind of comments are the CFO, CEO making? Are they being optimistic? Are they downplaying what may happen? Is recession still coming? I don't know. There's a lot of questions that each company, when they report, you can have a set of each questions for each company because each company does something different and each company trades differently.
Yeah, 100%. I mean, like you said, the guidance is typically more important than the actual earnings. It's not about what the company did last quarter. It's about what is the company going to do going forward the next quarter and the one after that. Which, look, I wish I knew. I wish I knew for any of these companies what they were going to do the next 2 quarters. I had a crystal ball. It'd probably make investing a lot easier. I don't, so it's not easy. But speaking of what can be easy, I think is a strategy that I think a lot of Americans employ that just have retirement accounts. Like I have a retirement account through my job here at Benzinga that I, contribute to from my paycheck biweekly every 2 weeks. Just some of it goes directly into, and you can select these different, your different ETFs or funds that you want exposure to. For me, I just hold, the S&P 500 index as well as some other kind of smaller ones. But that actually is quite easy. And when you're doing that, you don't, I don't even look at it. I don't care about what the transactions are doing. If some stock that I hold in my long-term portfolio reports bad earnings, oh well, it's probably in my long-term portfolio for, because I like it long-term, not just into this next earnings report. So always be wary of the overreactions that come after, especially if there's a big time earnings report. Like the one that comes to mind, you have Netflix and Meta last year. I mean, if you look at Netflix's, some of their earnings, I mean, this one dropped 30% in a day last April. So probably after Q1 2022's earnings. And the reaction there, it felt like on the street, at least, that it was like, oh my God, this Netflix company is such a dump. It's never going to make money. Who would want to touch it? Who would want to buy it? And I think that was just a gross overreaction to that earnings report. Because you can see here, within a few months, the stock was trading back above 380. So, I wouldn't take too much from it right now. So, Nick, what do you think?
It's going to be very interesting for Netflix just because we've been getting a lot of news recently how they're cracking down on password sharing and the terms. So I think there was a report that they want to get rid of one of the levels, I think it's one of the basic levels of Netflix. But this password sharing, are people able to bypass it? I don't know of anybody that has tried it, but just moving addresses and saying, we'll give you my account. I personally, we have Netflix at my house, but we actually don't share it with anybody outside our home just because we don't want to pay an extra $7.99 in user. But Netflix is going to be very interesting when they report because are they getting more subscribers or are people, once they get on the free trial, canceling and saying, it's not for me. Maybe I'll go to another streaming platform like HBO Max, Disney, Peacock. But it's very interesting because actually starting yesterday, Peacock is no longer free for Xfinity members, for Comcast Xfinity members. You actually have to pay one of the tiers, no matter which tier it is. I think you do have to start paying. And so are you going to be able to share your own Peacock account? Is Peacock, Comcast Xfinity going to be cracking down? Or is HBO Max going to be cracking down? Is Netflix just the start of this series saying no more password sharing? We're cracking down. Is this the start of a new era that streaming platforms, you won't be able to log in from a different device. You'll only have a set limit amount of devices. And is Netflix going to be the start of this, saying HBO Max no longer like? Is this the new streaming area? You can't share anything.
It'll be interesting. I mean, Netflix has talked about that for a while. Its efforts to want to, crack down on password sharing and whatnot, and it seems like it finally started doing so recently, which may have, started bringing in new subscribers. I think I did see an article about that a couple weeks ago, that the influx of new subscribers from people who have been kicked off has already started. You also have, again, that new ad supported tier, which to me was a no-brainer for Netflix. It's a double whammy if you think about it, because all right, so Netflix introduces a new tier for, say, $6 or $7 a month. I don't know what it is, but it has ads. What you're doing as a company is you're introducing your product or service to a whole new a whole new population of people that would have been priced out at your previous price point, that now, are interested, right? If you look at the supply and demand, at $10, Netflix has a certain amount of demand, and at $5, it has an even higher amount of demand. So by lowering that price point, you're getting in that whole chunk of people who did not have a demand for the product at its initial price point. But then what you're doing, B, is you're bringing in revenue from the people that are advertising with your company. So you're bringing in extra revenue, again, A, from people who wouldn't have been interested in your product before, and then B, from advertisers. So again, I don't know what took Netflix so long to want to do this. I think maybe a lot of people felt that it would dilute the product, or maybe people were worried that people are going to be going from full payment or full price subscriptions down to the lower one, which I don't think that's true. I'm sure some people did, but I think for the most part, if you were already paying 15 or 18 or $20 a month for Netflix, you probably still are. And then if you didn't have it before and you're looking at it now, then maybe, you consider the cheaper one if you don't care about the ads.
Yeah, it's going to be very interesting to see what other streaming platforms and how they do this. Remember, Netflix was getting a lot of heat saying this was a horrible decision. You shouldn't be trying to do this. And now when you look at it from the other side, from the other perspective, a few months later, they're starting to grow. They're getting a lot more revenue. They're starting to get more subscribers. I think the subscribers number is going to be very important for Netflix to see, are they growing after they implemented this crackdown on password sharing? Do they see this in the future? Do we see like a number that says each year, each month they do a projection of what their target is? Are they going to actually, maybe when they report earnings, they transition into a new thing of each month they publish subscriber numbers to say each month we gained and we're on track to meet this target. It would be very interesting to see how they would break down their metrics, if they still do, with the subscribers.
100%. All right, Nick. Well, I see my next interview in the background hanging out, so I'm going to go ahead and let you go. We'll see you on Thursday.
Yep. See you on Thursday. Thanks for having me.
Oh, thank you for joining the show. Thanks as always.
All right. Have a great day.
I saw Nick Stash talking about Spot in the chat. Spotify, kind of similar business model to Netflix, of course, a subscription based service. Spotify stock, I haven't looked at this in a while, has been performing really well. I mean, you look at where I have my line drawn to, back from really since the beginning of the year. Opened the year January 2023 at about $80 a share. We're all the way up to 160 right now, so up nearly 100% in the year for Spotify. Spotify, I mean, to me, it's, even though it's up 100%, it doesn't really look that expensive. You look at the price to sales, 2.2. No PE right now loaded on here, but you think about these companies, Spotify and Netflix. I mean, they have millions of subscribers that pay $8, $9, $10 a month or whatever. Not a bad business model, right? Because it's not that much money, so I don't think you have high, not switching costs, but people probably aren't. There's probably not the highest churn rate because people aren't like when I'm looking through my finances and being like, oh, I spent so much money this week. What did I spend my money on? It's never, oh, that $15 to Netflix or that $10 to Spotify, because those are very small purchases compared to other ones. I just don't know with Spotify, like the growth aspect of it would kind of scare me, because who doesn't already have Spotify or Apple Music? Who's not already paying $8, $9? Like, where's the growth going to be coming from? Just new people entering the turning 18 and needing to pay for music. I don't know. All right. Let's go ahead and bring on our next guest of the day. We're bringing on Lance Alstodt, the CEO of BioRestorative. So without further ado, let's go ahead and give Lance our very special Zinger Nation welcome. Talk to him when we come back. Lance, how are you doing today? Welcome back to the show.
Hey, Aaron. Thanks for having me. Appreciate it. Good to see you again.
Of course. Yeah. Do you mind just giving yourself a brief introduction and maybe introduce the company as well for people who may not be familiar, may not have been with us last time?
Yeah, sure. Lance Alstodt, Chairman CEO of BioRestorative Therapies. We're a NASDAQ listed, publicly traded emerging growth biotech. We've got two platform technologies. One is in chronic lumbar degenerative disc disease, where we have an active phase 2 clinical trial. And the other program that we have is related to metabolic disease with a focus on obesity and type 2 diabetes using a thermostem program, which is brown adipose fat tissue.
Got it. So I understand yesterday or this morning, I should say, we had some very exciting or good news regarding the trial. Could you walk me through that and what that news was?
Sure. So we had a major binary outcome with respect to data on safety. And because our fast track designation to get into a phase 2 occurred when we had met with the FDA originally, we didn't do a phase 1. So they asked us to do a small amount of patients in a sentinel group, call it 4 patients, to really study the safety profile of the product in order to really move forward into an open enrollment. So we enrolled the 4 patients. They were harvested. They were treated with the product on a 3-to-1 randomization. So 3 of which received the product. 1 received a saline placebo injection. And our third-party medical monitor had monitored each of these patients throughout the process, put together a report, and we sat down with the DSMB, which is the safety review board, effectively, that evaluates this, and they make recommendations. So the recommendation could have been one of 4 things. It could have been what we received, which is a unanimous decision to continue the study according to the current version of the protocol with no changes whatsoever. It could have been a continuation of the study according to the current version, but with proposed changes. And then the other 2 recommendations could have possibly been a suspension of the study for reasons documented or a study termination for reasons documented. So we sort of hit it out of the park, 10 out of 10, as it relates to the safety profile, which gives us a tremendous amount of confidence as we move into the open enrollment aspect of our trial.
Yeah, I mean that sounds like all great news there. What do you think the market isn't, I guess, understanding about this news?
Look, I think this is a game of supply and demand at this point. I think there's a lot of sellers out there. We're, in the position such that, we're an emerging growth biopharma, and it really hasn't been very kind to these companies and these stocks over the last 12, 24 months. However, we have traded at the very high end of our 52-week high. We're up close to 120, 130%. So people that have gotten into the story at $2.50 are now looking at this and saying, well, maybe we'll sell on the news. I think that's a strategy that people employ. It's not a strategy that I would employ because we have a lot of catalysts and milestones that are up and coming, and we continue to be, fairly well funded and able to accomplish a lot of these milestones through our existing cash. And we have really, this really establishes the safety profile of our program, which is our primary endpoint in connection with this phase 2. So by establishing that now and focusing on some of the efficacy related issues like the reduction of pain and the increase in function are going to be that much easier. So we're really excited about what's ahead of us, not only within this program, but the fact that we get to leverage this now, given the safety profile across other indications of the body, as well as start to accelerate our brown fat obesity program. So there's a lot that's on the horizon. I think investors are maybe missing that aspect of it. And I think there are more sellers than buyers here today. I think that dynamic will probably change throughout the day and into tomorrow as things sort of normalize. I think just because of the sheer volume that's a little bit atypical from what we usually see, people are viewing that as an opportunity to liquefy.
Yeah, so Lance, let's talk about the obesity pipeline a little bit. I mean, there's been a bunch of talk about different weight loss drugs and whatnot this year. I mean, how can you talk about yours a little bit and how it might be different from others out there?
Sure. Well, we're not a GLP-1 company or pharmacological from that standpoint, but we believe that with our very powerful and potent brown fat cells that are derived from brown fat tissue, what we have is a proof of concept in a preclinical setting by which we have taken those brown fat cells and created brown fat adipocytes on 3D matrix that have been implanted into the fat pads of small animals through a mice model for obesity. And what was shown was that the mice actually lost weight, they lowered their blood glucose levels, and they lowered triglycerides and other therapeutic benefits. So brown fat has been shown to regulate metabolic homeostasis in the body. It is a very powerful cell that we have manufactured and have homegrown from an intellectual property perspective. It's allogeneic, it'll be off the shelf, and we intend to accelerate it. We also believe that some of the large biopharma companies and pharmaceutical companies would be excellent partners with us as they continue to go down the path of their GLP-1 strategies. And this can be used in connection and in combination in a complementary fashion with some of those strategies. Rather than taking something like this every day or several times a day or several times a week, this is something that we intend to inject or implant into the human and have that effect go on for several months, if not 6 months or 12 months, where we're still studying the duration of this type of product. But we believe that that's a very interesting and differentiated feature.
Yeah, I mean, it seems like with the major pharma companies and these different drugs coming out, whether it's Ozempic, like I said, there's been a lot of talk about it, whether it's from an interest standpoint of people who want to try it out, or from an investor standpoint where people are looking at these things saying, "Oh my God, everyone's going to be taking this on." And I have seen some things basically saying that for some people, once they start those, they may have to stay on them essentially forever to keep that weight off. I mean, they seem essentially like miracle drugs for a lot of Americans. Do you think there will be some, adverse effects from these becoming more prevalent? Do you think they're, gonna?
Yeah, I mean, it's a good question. I think what we don't know is really what we don't know at this stage, and time will cure all of that. But I think their heads are in the right place. Their trials are constructed in a manner that's consistent with really bringing the best drug available to the market in these huge unmet needs. And we share the very same philosophy. Now, we're doing it on a cellular level. So we believe that from a side effect perspective or adverse event perspective, we're not going to have those challenges as some of the more pharmacological solutions. And we're not going to have to be, taking this drug on an everyday basis. So having it implanted into the body, which is very complementary to your existing brown fat, the issue is really increasing the reserve of your brown fat in order to regulate that metabolic homeostasis such that it counteracts against some of these metabolic related diseases, whether they're obesity or type 2 diabetes or hypertension or polycystic ovarian syndrome within women. It's really going to reverse that effect and hold that effect for a longer period of time in a more organic way without those side effects. So we're excited about our programs. We intend to accelerate them. We'll have a DMF in place at the end of this year for licensing opportunities. We'll have pre-IND meetings with the FDA at the end of the year and hopefully be in the clinic early next year. Like I said, I think this is a very partnerable program with big cap pharma and even medium-sized companies that are publicly traded that are focused within the obesity space.
Yeah, it sounds like something, like you said, that would make sense to kind of work together as opposed to one or the other. And I mean, despite there being some concerns maybe about some of these drugs from the big pharma companies, like I said, about people maybe having to stay on them for life or some adverse side effects that we may not know about yet. Like there's such an obesity problem in America that again comes with diabetes and all these other complications and different comorbidities that the benefits from these drugs may outweigh these potential side effects in the long run. It's been one of the biggest investing stories of the year so far. As everyone,
yeah, no, absolutely. I mean, I think that's true, and I think the efficacy will ultimately drive a lot of these issues that we're trying to sort out. And I'm just glad to report that in our animal studies, we had weight loss that was consistent with some of the GLP-1 companies in that kind of 8 to 10%, monthly weight loss. So what we're doing is focusing on this unmet need, bringing the best programs and the best products to market, and really prosecuting the regulatory pathway throughout. And we think this is going to be a really exciting value driver for our company and our shareholders going forward. We've had the benefit of having a lot of wind at our back this year. Our spine trial is hitting all 8 cylinders. We're so pleased and really proud of the strong results that we got in connection with the safety profile. And now that safety profile is established, we can really jump into the open enrollment aspect of our trial, as well as really leverage this program across all the other areas of the body, like the hips, the knees, the shoulders. Now that it's safe, I think there's going to be a lot of interest from an investigator-initiated study perspective and seeking additional INDs in other parts of the spine and other parts of the body.
Yeah, I mean, again, like all those results that you guys are getting, it sounds incredible. I'm excited to keep following along the story. Lance, we're coming up on time here. Is there anything else you would like to address with the audience before we let you get on with the rest of your busy day?
Sure. I mean, I just think that where we are today is a testament to all the hard work that we've all done at the company and we continue to do. This is just one milestone amongst many that we have over the next 12 months. So we look forward to prosecuting them and staying in touch with our shareholder base and the Wall Street community that you have a nice read upon. So we look forward to hopefully coming back on the program with more news.
Awesome. Well, we're excited to have you on whenever that time comes. I will go ahead and drop that press release and article in the chat for people to learn more.
You.
Lance, thanks as always for hopping on today. I know you guys are busy over there.
Thanks, Aaron. Take care. Bye-bye now.
No problem. You too. All right, guys, that was Lance Alstodt from BioRestorative, ticker BRTX. We'll drop that link in the chat as well. Guys, we are going to go ahead and wrap up a little bit early today. We are running, we've got an interview for the Raz Report we are doing at 1 p.m. We got to prep for. So with that, I'll go ahead and let you guys get back to trading. Make sure to come back and tune in Thursday for another episode of Benzinga Live. Till then, make sure to follow us on, why does it look so dark outside on the screen? It looks like we're about to get stormed. I did get caught in a very bad storm over the weekend, by the way, which I don't mind, like thunderstorms in the summer. Rain in the summer is not my least favorite thing in the world when the rain's like, not freezing cold or anything. But when the lightning starts striking and then you're like doing the thing where you're counting the thunder in the head and then you realize the lightning's within like a mile of you, I was like, all right, I need to get inside. I need to get out of here. All right, but that's neither here nor there. Make sure to follow us on Twitter, Instagram, TikTok, wherever you get your news. Make sure to like the YouTube video and subscribe to the channel as well. Peace and love, y'all. We will be back on Thursday.
This is Benzinga.